Hello everyone, welcome back to the channel. Today we are going to talk about the third pillar of your pre-approval, and we're going to talk about credit. Here we go. So today we are talking about credit. Now, there is so much to know when it comes to credit, but I'm going to cover some of the basics here to kind of help you with understanding how it's going to affect you getting pre-approved when you're looking to buy a house, because credit is one of those things that can take time to fix if things need to be fixed. So the first thing we'll talk about is what are your good credit scores? Where do you want your scores to be if you're going to look to purchase a home? Well, first you need to know that you get 3 scores. Okay, you have Experian, TransUnion, and Equifax. Those are the 3 bureaus that are going to give you scores. And when it comes to lending, we're going to look at your middle score. So whichever number falls, whatever your range is, the one in the middle is the one that we typically go by. Now, some new rules just literally came out where, depending on what kind of loan program you're doing, you might look at the credit scores and average them. And if the average is over the minimum, you're okay to go. That's brand new though. And things do change from time to time when it comes to credit. So if you're thinking, I want to try to purchase something, but my scores are really low, what can I do to help? We'll talk about that in a little bit. But for right now, what's a good range to be in? If you've got at least a 640 middle score, you're going to be in the range to be able to use conventional financing, VA financing, FHA financing. 640 is a nice solid spot to be. Now FHA can go lower and VA can even go lower depending on the rest of your file. But in general, you want to be around 640 or higher. The best, at least where you kind of top out in terms of credit, is going to be 740. If you're at 740, not much is going to get better for you if you have higher, if that makes sense. So for certain financing, not only do you need a minimum credit score just to be able to use that program, but also it's going to affect your rate and your pricing on your rate when you go to lock in an interest rate when you're in escrow to buy a home. So FHA is not as dependent on that. FHA financing, not as dependent on a FICO score, but conventional financing definitely is. And that's going to affect your rate. So we'll get into interest rates and how they work in a future video, because that's a whole thing onto itself. But at least for this, for no understanding credit, 640, 740, if you're in that range, you're going to be able to do something. So your next question might be, well, what if my credit is lower? Okay, so we'll talk about what we can do to help it. But just some general information on credit and how it works. So the credit bureaus, they're looking at what credit is being reported to them. So not all accounts actually get reported to all 3 of the bureaus. Sometimes they only get reported to 1, maybe 2 of them. Sometimes they don't report at all. This happens with mortgages sometimes, which you would think is kind of crazy because it's this giant chunk of debt. But certain accounts don't always show. So that's why it's really important to kind of know your stuff. I've talked about that in earlier videos. Know your stuff, know what you have out there, know what you owe. So when it comes to the credit and how it's being read, each bureau says they pretty much have a proprietary formula that they follow. But essentially it's going to look at what kind of accounts you have, how long have you had them, and what's your payment history on them, what's your balances, and things like that. Credit cards are one of the biggest things that will move your scores up and down, in my experience. Now, I'm not a credit expert. I'll never say that I am. I've just looked at a lot of credit reports, and I've seen what people do to try and improve their credit scores and try to help with getting ready to buy a house if they're just a little under and they're trying to get into a spot where they want to be, or if they're really under and they know they got some work to do. I've seen a lot of people do a lot of different things. But what I've seen the most that actually helped a lot of people was they had to actually be using some kind of credit. They got to be using some kind of credit card, at least 2 or 3 of them. Anything less than that, and then the bureaus don't have enough information to give you good scores on. They need a little bit more. You can have a car. You can have a large installment loan like a car or a boat, but that's not very dynamic. If you think about it, you take out a large balance on something and you pay back a specific amount over the prescribed term of whatever's agreed upon, 3 years to 5 years, whatever it is. It's not very dynamic. If you think of what could be something that is the most tied to someone's free will and what they have power over, that's actually a credit card. And the reason for that is that you choose what you buy with it, and you choose how much you put on the card, and you choose how much you pay back and when. So credit cards actually do a lot for your credit score, which it seems like it would be self-explanatory, but it really isn't, because if you have a lot of installment loans, like I said, like car and auto, they don't do a whole lot. Even paying that account off may not do that much for your credit. If you only have one auto loan and maybe one credit card, paying off that auto loan might actually hurt your credit, because now there's nothing to read. It just shows as 0. So it kind of gets tricky, but that's just one of the things when it comes to credit. So having 2 or 3 accounts, something that you pay on time, that's the biggest thing too. Late payments, ooh, they hurt your credit score. And that means 30 days late. I don't mean, a 30-day late is what starts to get recorded and what starts to run over. If you're 30 days, 60 days, 90 days, they're always in 30-day increments, and they hurt your credit score. Now, the crazy thing is, if your credit score is really high, let's say you're almost at 800, something very small like you go over your balance or you have one late payment actually hurts your credit way more than if you have marginal credit. Let's say you're in the mid 600s and you maybe have some old lates or something. If you have another late, it doesn't really hurt your score as much. It might drop it, 20 points or something, but if you have 800 and you have a 30-day late, which is not normal for you, it could drop your score 100, 150 points. It can be very detrimental. It's kind of a weird quirk when it comes to that. So just to be aware of the different kinds of accounts that you can have. Authorized user accounts. So you have someone, either your significant other, your family, they have a credit card, and you are an authorized user on that account. That will start to report on your credit as if you're an authorized user, and that can help your credit scores as well. That can help improve it. Now, when you're trying to qualify to buy, sometimes you are responsible for that payment as it is on your credit report, but that's not always the case. That really depends on the loan program and what the situation is. But that's just something to be aware of with your credit. So when it comes to conventional financing, you want to have the highest credit score you possibly can for 2 reasons. For one, your interest rate is going to be tied to however good your credit score is. And 2, if you're putting less than 20% down on a home, then you're going to have mortgage insurance. And mortgage insurance is going to be looking at your FICO scores. So if you have very marginal credit, your mortgage insurance can actually be pretty expensive. And mortgage insurance is something that's a part of your monthly payment. That doesn't protect you. It actually protects the lender against you defaulting. So I'm going to do a whole video on mortgage insurance because it's kind of a thing that it confuses some people. And it's one of those things where like, why do I have this? It says insurance, but it's not helping me. And it's because it's not for you. It's actually to protect the lender against default. FHA has mortgage insurance on it as well. It's at a fixed rate. So if your credit's just high enough to qualify, and you're going to have mortgage insurance, at least it's one specific number. It's not going to go up or down. And sometimes it can be a lot less than what it would be if you were trying to look at conventional financing just because of where your FICO scores are. So those are things to be aware of. Old derogatory credit. Things like collections. If you have collections on your account and they're old and they're about to fall off, okay, great. They're only going to be on your account for about 7 years and then they fall off. Everything is on there unless somebody calls you trying to collect on it and you say, yes, that's mine, then it can be thrown back on there. And now it's on there for another 7 years. But when it comes to collections, you don't always have to pay them off. But the real thing is to get them deleted. Okay? And real quick, if you like these videos, if you like the content, if you're learning something from it, do a like right here on the video. Take a quick second and do that. Go ahead and subscribe to my channel. I'm just looking to help kind of build this and kind of help get this information out to people. It's really important stuff to know. And if you know someone who's looking to buy a home and they don't know much about things and they just have questions, this is a good resource for them. I'm going to keep putting stuff out there and they can look up whatever they have questions about. So just my little plug there. So what was I talking about? Collections. If you really want your FICO scores to go up, if you really want to help them pop and you have collections on there, the best way and really the only way for them to actually help your credit score is to get those accounts deleted. So you say, well, how do you get them deleted? You have to call the creditor and you have to say, look, I'll pay you X because, they bought that debt for pennies on the dollar to try to collect on it. I will pay you X, and in return, I want a letter from you stating the account is paid off and for the bureaus to delete it. If you just pay it off, it's still going to sit there. It's just going to show a zero balance, which can help in some situations. But if it's talking about your FICO score, your actual credit score, it's not going to help that much. So that's the main thing that you want to be aware of. So I know this video is running a little bit long. I just want to make sure that get some basic information out there. If you have any questions, go ahead and leave any comments below. I'm probably going to do more videos on this in the future just because it's something that it really holds a lot of people up. They can get very discouraged when it comes to their credit. They think it can be very arduous and it's going to be very long before they can do something. But I've seen people turn their credit around in 30 days, 60 days, 90 days. I've seen them do it in those time frames. And they were able to buy much sooner than they thought because they put the effort toward it. So, yep, if you haven't already, like the video, subscribe to the channel, and I'll talk to you guys another time. Bye.